Let's get our hands dirty. We're about to dive into a topic that affects so many of us: buying a home. It's a journey filled with excitement, anticipation, and let's be honest, a fair bit of confusion. Buying a house and getting a loan for it, it's a huge step, a milestone that many aspire to achieve. It represents stability, a place to build memories, and often, a significant financial investment. Seems intimidating, right? The world of mortgages and real estate can feel like navigating a maze, filled with complex terms and daunting requirements. It's easy to feel overwhelmed by the sheer volume of information. There's a myth that you need a flawless credit score, an 850, the kind of score that seems almost unattainable. It's a common misconception that only those with perfect credit histories can even dream of owning a home, and a mountain of cash for a down payment. The image of needing a massive pile of money, enough to make Scrooge McDuck jealous, is often associated with buying a home. That story scares off more people than it should. These myths create unnecessary barriers, preventing many deserving individuals and families from pursuing their dreams of homeownership. Truth is, you don't need to be a financial superhero, a Wall Street tycoon, or someone with an impeccable credit history to qualify for a home loan, to get a conventional loan. Conventional loans are far more accessible than many believe, designed to help everyday people achieve their homeownership goals. Most homeowners I know are regular folks who learned the real rules, not the scary stories. They're teachers, nurses, small business owners, and people from all walks of life who took the time to understand the process. Getting a loan is more like assembling IKEA furniture. It requires patience, attention to detail, and following instructions carefully. Then climbing Everest, confusing at first, but doable step by step. Each step, while potentially challenging, is manageable with the right guidance and resources. The system is built for hardworking Americans, for those who contribute to their communities and strive to build a better future for themselves and their families. Not just Wall Street wizards. It's not exclusively for the elite, but for anyone willing to put in the effort to understand the process and meet the requirements. So let's break down the real requirements and see how you can get the keys to your own front door. We'll demystify the process, separate fact from fiction, and empower you with the knowledge you need to make informed decisions. Forget the myths, the outdated notions and fear-mongering stories that hold so many people back. Let's get to the facts. Let's uncover the truth about credit scores, down payments, and the overall loan application process, so you can confidently pursue your homeownership dreams. Before we dive into the world of mortgages, let's define our terms. It's important to have a solid understanding of the different types of loans available, so you can make the best decision for your unique financial situation. We'll be exploring various loan options, but first, we need a baseline. What exactly constitutes a conventional loan? A conventional loan is simply a mortgage, a financial agreement where you borrow money to purchase a home, agreeing to pay it back over time with interest. It's the foundational concept of homeownership for many. But here's the key differentiator: it's not backed by the federal government. This means that unlike some other loan types, the government isn't insuring or guaranteeing the loan. The risk falls primarily on the lender. Unlike FHA, which stands for the Federal Housing Administration, or VA loans, designed to assist veterans, active duty military personnel and their families, it's a private deal between you and a lender, such as a bank, credit union, or mortgage company. The terms and conditions are negotiated directly between you and the lending institution. Most conventional loans follow rules set by Fannie Mae and Freddie Mac. These are government-sponsored enterprises, or GSEs, giant organizations that buy loans from banks. This process is crucial because it frees up capital for banks to issue more loans, keeping the mortgage market flowing. These rules keep things consistent so you know what to expect. They standardize many aspects of the loan, from the application process to the appraisal requirements. Think of a conventional loan as the standard model in the world of home financing. It's the most common type of mortgage. Reliable, widely available, offered by a multitude of lenders across the country, and often with great rates if you qualify. Because they are so common, conventional loans are subject to market competition, which can lead to more favorable interest rates for borrowers with strong credit. It's not a specialized tool designed for a specific group or situation, but the workhorse of home loans, the go-to option for many homebuyers. It's the foundation upon which much of the housing market operates. Qualifying is more achievable than you might initially think. While there are requirements, they are often straightforward and attainable. The requirements don't drastically change from bank to bank, thanks to the influence of Fannie Mae and Freddie Mac. This standardization makes it easier to compare offers from different lenders. If you fit the guidelines, meaning you meet the credit score, down payment, and income requirements, you're in the game and have a good chance of securing a conventional loan. Let's look under the hood and explore the specific requirements and benefits of conventional loans in more detail in the following sections. We'll break down the key components so you can determine if this type of loan is the right fit for your home buying journey. Let's talk credit scores. You don't need a perfect score, just a decent one. Most conventional loans require a minimum score of 620. Higher scores get you better rates, but 620 gets your foot in the door. If your score is lower, you can work on it. Pay bills on time, keep balances low, and don't open or close accounts right before applying. Your credit score is a tool, not a judgment. Lenders know life happens. What matters is a pattern of responsibility. Don't let fear of an imperfect score stop you. Start the conversation. You might be closer than you think. It's about showing you're on the right track. The process is more forgiving than the myths suggest. Let's move on. Alright, let's tackle one of the biggest misconceptions in the world of home buying: the down payment myth. This is the idea that you absolutely, positively need a massive 20% down payment to even think about getting a conventional loan. It's a daunting number, and it keeps a lot of people from even starting the process. But is it really true? Let's find out. The simple answer is, you do not need 20% down for a conventional loan. That's right, you heard me. It's a myth, a misconception, a financial urban legend. The truth is far more accessible and achievable for most aspiring homeowners. Many programs allow as little as, well, you might be surprised. The landscape of home loans is diverse, with options tailored to different financial situations and needs. Don't let that big 20% number scare you away from exploring what's actually available. 0.3% down for first-time buyers. Yes, you read that correctly. Some programs, especially those designed to help first-time buyers, allow you to put down as little as 3% of the purchase price. That's a huge difference from 20%, and it opens the door to homeownership for a much wider range of people. That's a much more realistic goal. Suddenly, saving for a down payment doesn't seem like such an insurmountable task. It becomes something tangible, something within reach. It transforms the dream of homeownership from a distant fantasy into a concrete possibility. Then saving up 20%. Think about the difference. Saving 3% versus 20% is like comparing a small hill to a towering mountain. One feels manageable, the other feels overwhelming. Don't let that overwhelming feeling paralyze you. The 20% number is just the threshold. And it's important to understand why. It's not some arbitrary figure pulled out of thin air. It's tied to a specific aspect of mortgage lending that protects both you and the lender. For avoiding private mortgage insurance, PMI. PMI is essentially insurance that protects the lender if you default on your loan. When you put down less than 20%, you're considered a higher risk, and the lender requires PMI to mitigate that risk. If you put down less than 20%, you'll pay PMI, but it's not forever. This is a crucial point. PMI isn't a life sentence. It's a temporary cost associated with getting into your home sooner rather than later. Once you reach 20% equity, you can remove PMI. As you pay down your mortgage and your home's value potentially increases, you build equity. Once you own 20% of your home, the lender no longer requires PMI. PMI is just a temporary cost to help you get started sooner. Think of it as a bridge, a stepping stone, a temporary toll on the road to homeownership. It allows you to get into the market, start building equity, and enjoy the benefits of owning your own home without having to wait years to save up a massive down payment. Don't let the 20% myth keep you from buying. It's a barrier, a false obstacle that prevents many qualified individuals from achieving their dreams of homeownership. Break free from that myth and explore the possibilities that are actually available to you. Focus on what you can save, not an impossible number. Set realistic goals, create a budget, and track your progress. You might be surprised at how quickly you can save up a 3% or 5% down payment. The real rule: get in with what you have, even if it's not 20%. The important thing is to get started, to take that first step on the path to homeownership, and build equity over time. As you pay down your mortgage and your home's value potentially appreciates, you'll build equity. This equity is an asset that you can use in the future for things like renovations, investments, or even retirement. The system is designed to help you start, not keep you out. There are resources available to help you navigate the home buying process, From loan officers to real estate agents to online tools and calculators. Don't be afraid to ask questions and seek guidance. So, ditch the 20% myth and embrace the reality of accessible home ownership. Let's talk about the next step. Time for a little math. Your debt-to-income ratio, or DTI. DTI compares your monthly debts to your gross income. Most lenders want your DTI at 43% or lower. Sometimes strong applicants can go a bit higher. Lower your DTI by paying off debts or increasing income. It's a balancing act. Less debt, more income, better odds. Lenders look at the big picture, not just one number. DTI is one of the most powerful levers you can control. Know your numbers before you apply. It's simpler than it sounds. Lenders want to see steady income. Usually they look for a 2-year work history, not necessarily at the same job, but steady employment. Job changes are fine if they make sense. Gaps need to be explained. Self-employed? You'll need 2 years of tax returns. Documentation is key: pay stubs, W-2s, bank statements. It might feel invasive, but it's just proof you're reliable. Show you earn a steady living, and you're in good shape. The paperwork is just part of the process. Let's see what else matters. It's not just about you. The house has to qualify too. The lender uses the house as collateral, so it must be in good shape. A professional appraiser checks the home's value and condition. The house must be worth at least what you're paying and meet safety standards. Major fixer-uppers usually don't qualify for standard conventional loans. If you want a project, look into renovation loans instead. For a regular loan, the house should be move-in ready. Watch for red flags when house hunting. The bank wants a solid investment, so should you. So, who's the ideal candidate for a conventional loan? Someone with a solid, not perfect financial picture, decent credit, manageable debt, and a reasonable down payment. It's great for move-up buyers using equity from a previous home. If your credit is bruised or you have little cash, FHA loans might be a better fit. FHA loans have more flexible requirements and lower down payments. The goal is to find the right loan for your situation. There's no shame in using FHA to get started. Conventional loans reward financial stability but aren't the only option. Pick the tool that fits your needs. Let's wrap it up. Here's the bottom line. Qualifying for a conventional loan isn't an impossible dream. It's a process, not a mystery. Millions of regular people qualify every year. Don't let myths or fear hold you back. You might be closer than you think, maybe just a few steps away. The worst that happens, you get a clear plan to improve. Homeownership is achievable and worth pursuing. The tools and information are out there. Reach out to a trusted mortgage professional. Find out where you stand. You could have keys in your hands sooner than you think.